Welcome to a Wiser Retirement podcast. Before we get started with the episode, I want to tell you about a new ebook available on our website called Buyer Beware. Why do they keep trying to sell you that annuity? This ebook covers the various types of annuities, negatives to owning annuities, and better investment alternatives to annuities. To download this ebook, you can click the link in the episode notes or go to wiserinvestor.com and you'll find it at the bottom of the page. Now on to today's episode.
Welcome to the Wiser Retirement Podcast, where we believe the best financial advice should always be conflict-free. I'm your host, Casey Smith, guiding you to financial freedom. Today are my co-host, Michaela Dowdy and Andrew Pratt. Hey, guys.
Hey, Casey.
Hey. So we got Team Wiser here today. Andrew is our investment manager, and Michaela is our planning associate. And I would like to know who schedules the podcast right after a Braves game. Who's in charge of that?
That is marketing.
So this will post, this podcast will post on October 30th. But today the Braves have entered the playoffs, and we almost lost our game 2 last night, but we came through.
Right. Yeah. Where my support today?
I tried to buy the best tickets possible. Kind of picky about where I sit. And this go around, I just went on with the masses, and I bought the tickets when it becomes available to the public on Ticketmaster. And it's crazy. Have you guys ever done that? No. It's like they put you in queue, and I was like number 3,000, and then it counts down, and finally, like, hey, it's your turn to pick your tickets. And there's all these dots everywhere where all the available seats are, and the dots are disappearing. It created so much anxiety that I think I'd rather pay 5 times the amount of StubHub and carefully choose my seats, right? And so I was like, I don't know, left field corner. All right, let's do that. And so I was looking for 4 tickets. I ended up, there were no tickets available for 4. So I dropped it to 3. And then some of them were popping, but they were disappearing pretty quick. So I was like, pick those. Man, great deal, $75. But I've never sat in that section ever. And so I just thought I was going to be sitting in the left field corner. Like, I had no idea that there was an overhang. And I was the back of the underneath section. So you couldn't see the fireworks. You couldn't see the Jumbotron. You couldn't see the ball if it left the bat and it didn't go to the ground. And so me and the kids are sitting there, and they're all looking at me like, really? This is the best you could do?
You were in the atmosphere.
Yeah, it was a cool atmosphere. So hopefully we have a good rest of the playoffs. Anyway, grateful for what you got, right? Not what you want to have. I guess that's what it comes down to.
Beggars can't be choosers.
Right. I was definitely the beggar. All right. So, we talk a lot about financial planning, and we don't dive in our podcast into individual securities at all. We're a firm that focuses really mostly on index funds, but I've just noticed lately in some of our meetings that we've had talks about mutual funds and ETFs, and people trust the process, and I understand that, but I'm a dork, so I like going into the weeds sometimes, right? And so it's I wanted to highlight the differences between mutual funds and ETFs today, because there are so many mid-sized financial planning firms that we end up managing the assets clients come to our firm, and I just picture these old guys, sleepy, still wearing coats and ties to work, and they have their mutual fund selections that they have. They've been using them since the 1980s,
Right.
And so when I think of mutual funds, or whenever I see a portfolio full of mutual funds, I think of 2 things. One, a firm that doesn't know how to get with the times and the efficiency of modern day investing. And then the second thing I think about is, they must be getting paid commissions, because typically at your average owned locations and your other brokers that they're getting a trailing fee from this mutual fund. So which we'll dive into. So whenever I see those, I'm typically kind of turned off by going, oh, okay, we have a old school portfolio here. But there's also very specialized mutual funds, that are still in existence, that probably have a purpose in portfolios. We're just not using those currently in our current environment. But anyway, so let's go back high level here and talk about mutual funds versus ETFs. So how do we explain that to someone?
Yeah, I mean, I think starting off, mutual funds and ETFs are very similar in that they represent a basket or a pool of underlying securities. And, for the most part, they are very diversified. They're not, very concentrated from a holding standpoint. But there are a lot of differences, whether it's the structure, the tax treatment, et cetera. So, going into some of these differences, I guess first off, mutual funds, it comes down to the trading, and mutual funds are priced at the end of the day. Whereas ETFs, you can actually buy and sell shares throughout the day when the market is open. So that is one big difference right off the bat between mutual funds and ETFs.
Liquidity. So you go to sell your mutual fund and you get the price after the market has closed and everyone knows what the prices of things are. Right. Where in the ETF, the unique creation redemption process allows for it to trade intraday.
That's right.
So there could be a situation in a thinly traded ETF where the net asset value, the value of the underlying securities, doesn't match the price.
Correct.
Meaning that you could be paying a premium for those basket of securities, or you could be getting them at a discount. Now, at our big box firms, your BlackRock, your Vanguard, your State Streets, that's not really a big issue. They're very tightly traded.
Right. And mutual funds and ETFs, they're different costs and fees. And with, both have a management fee or an expense ratio. Typically, ETFs are usually less because they're very more passive, not as actively managed. But I will say with ETFs, and not to get too technical here, there are implicit and explicit costs. And implicit costs really refers to that liquidity, that bid-ask spread. But as you said and mentioned, like the big ETFs, they're with a lot of assets. Those bid-ask spreads are very tight, and they trade close to that net asset value, and you're not going to have as wide of spreads. But the thinly traded ones can have that implicit cost, so that's something to be aware of. But both have some sort of net expense ratio or management fee attached to them.
So you basically, you could buy an ETF and you could be paying a big premium, and you think that you're buying something really relatively inexpensive, but in the end you actually paid maybe 2 or 3% more than what the basket was worth.
That's correct.
And it's really hard for everyday people to go and figure that out.
Right.
So you got to stick. You can't stick to like the obscure ETFs. You need to stick to the mainstream ETFs.
Right.
For those at home doing their own investing. So we talk about how they're traded. What about how they're managed?
Yeah, I mean, so primarily when you think of ETFs, they are passively managed, and that means that they're just tracking a benchmark and they're trying to perform in line with a certain benchmark. And that benchmark could be the S&P 500, it could be a sector, it could be the broad bond market index. So it could be, various, whatever index that this ETF sponsor is trying to create. Whereas most mutual funds are actively managed and they're trying to outperform a certain benchmark, whether it's the U.S. market, the S&P 500, et cetera. But
there's more actively traded ETFs coming on the market now. I mean, there's lots of them now. I remember at the beginning of ETFs back in, I guess, around 2004 to 2008, most of them were passive. Right. And now they have inverse ETFs that do the opposite of what the market does. Don't buy those. They have leverage ETFs, obviously, 3x the market on the upside. Then there's just mutual funds that have all but shut down their funds and moved into ETF world. Right. And it used to be, an ETF, it's good. And, I get frustrated because I feel like the industry should start calling them ETPs, exchange traded products. And then you would have your funds that were active and then passive. You also have, other things like some of the commodity funds are actually ETNs, exchange traded notes. I mean, they don't actually own anything. It's a promissory note by a bank to pay you the performance of something. Right. So we don't use ETNs for that reason. Think about this is way back, but you go back to like when Lehman shut down during the financial crisis, they had 3 ETNs that shut down. People just lost all their money, right? So people don't really think about those risks until they are in that situation.
Yeah, and to your point, I would just really, if what we look at is obviously the underlying security and portfolio, and if you're trying to do this on your own, there are those risky funds out there like ETNs or highly leveraged ETFs even that you don't really know like what the risk is unless you're doing a deep dive on the analysis.
I think one of the so costs can be very different. Mutual funds can be more expensive. ETFs should be cheaper. Average cost of our ETFs is around 0.08% per year, but the S&P 500 you can buy at 0.03. Most ETFs and most platforms will trade for free, so no transaction cost. I think the biggest difference is taxes. So
that's correct.
You have a substantial amount of money inside a brokerage account, and you have mutual funds. What's going to happen, Michaela? You're going to get a
nice tax bill at the end when all of the cost basis comes to you.
Right. So what the situation is, like in 2022, you had a loss that year. You lost money, but yet you still got a capital gains tax bill because of all the trading that took place in the portfolio. And so for especially for large brokerage accounts, the use of mutual funds just doesn't make any sense. When you have an ETF that can replicate that strategy, and they have a very unique creation redemption process with the AP, the authorized participant, and when that happens, they're able to shelter the shareholders from having to have that tax bill. Now, if you sell the ETF and you make a profit, you're going to pay capital gains tax.
Right.
It doesn't protect you from that. But it certainly protects you from being able to surprise tax bills at the end of the year.
Yeah, and obviously, when you sell an asset at a gain, you're going to have to realize those capital gains. But as you mentioned, with mutual funds, if there's a lot of turnover in that fund, they could distribute a surprise additional capital gain at the end of the year because of that turnover.
Yeah. So I think the kind of transition that further, let's say you have a portfolio full of mutual funds. You have to look at what the cost difference is between the funds, the mutual funds, and the ETFs. And so let's say that you realize that you could save $1,000 a year, but you've got a $20,000 capital gain, so it'll take 20 years to break even. But actually, if you go and look at the taxes, how much are you paying in taxes on the capital gains? That's typically 15%. So 15% of your capital gains bill would also be going away. So when you do that, you can apply it to the cost basis, right? Or to the break-even point. And so a lot of times the break-even comes down to like 3 years after that.
Right.
So that's something to think about when you're looking at an old school mutual fund portfolio. And clients don't seem to push back on that.
No, not often, unless we've had a few, I think, lately where, especially if you get blindsided by leveraged ETFs that have this insane return over a very short period of time. But the risk in those is so great that sometimes if the client's just looking at the rate of return, or mutual funds really do pride themselves on beating the market over and over and over again. And so when you have clients that come in and they're like, I'm going to get the best rate of return ever, I want to beat the market. But then, you go back to reality of realizing, well, in all actuality, there's a 4% chance they do?
Yeah.
So
2%. 2% over 20 years.
Chance.
Yeah.
Yes. So it really is like, well, you're likely not going to have that happen. And so just going back to those basics and explaining really what we're explaining in this podcast of ETFs and mutual funds, both are great investment vehicles, but really ETFs are going to hopefully have that better return for you in a more passive way, depending on if you're going in a passive direction.
So the leverage ETFs, let's talk about that for a minute. So I remember walking around ETF conference in 2009. This is right after, this would be like February of 2009. So we've just gone through 2008, which was a very dismal year, to say the least. And people were so shocked. And it's like every panel, you could have a panel about something not even related to ETFs, and somehow it would all come back talking about leveraged ETFs because these were relatively new products at the time. But people lost money in an inverse S&P 500 ETF. So you think, oh my gosh, the market's going to be totally down in '08 after what happened in the end of '07. I'm going to buy this leverage ETF product, and I'm going to make it 15, 20% of my portfolio, and I'm going to save the day for my clients. These are advisors walking around. There's no clients here. It's just advisors. And I think I'll have to go back and research that, but my memory, if it serves me correctly, is around 16% loss is what you lost by owning a leveraged, inverse leverage ETF.
Yeah.
And what people don't understand is it resets daily. So it really depends on how many up days or down days that you have. It has it has nothing to do with annual return. It's daily return.
Right.
And so when the leverage resets daily, you could have a lot of little down days, and then you have one big up day that could potentially erase all the down days and worse, put you into the red. And so that's where people get kind of greedy. The idea behind leverage ETFs when they were created is that you would buy it at the open to hedge your position, but you would liquidate it by the close. Mm-hmm. So it's supposed to be a day trading instrument only and not to be held overnight. But you have retail investors who buy these things and they don't read the prospectus, and they don't if they did, they probably wouldn't understand it. And they end up in a really bad position. Right.
Yeah.
And there's more up days and down days typically. Right. Or you have bigger up days, and sometimes the best up days are after the worst down days in volatile markets. Mm-hmm. So statistically, it doesn't make sense as to why you would own a leverage ETF unless you're doing some very complicated trading strategy for the day.
Right. Yeah. And I think that's where we come in as advisors and, portfolio managers, just again, understanding what these products are, like what's in them, what are the risks to the overall portfolio as allocation. And, that's where I think we provide that benefit to our clients.
So, it's definitely understanding the process and the product. There are ETFs that do other things. For example, there's COWS, Pacers ETF, COWZ, that buys the 100 most free cash flow companies in the Russell 3000, I believe.
1,000.
Or 1,000, okay, in the Russell 1,000. But that's basically a computer that's saying, okay, this is our selection. And it's replicating that, every single quarter it's resetting itself. So that's active management.
Yeah, that's active management ETF. And, with active ETFs, they are coming more onto the scene. So they are a little bit higher fee, but when I'm saying higher fee, I'm not talking about 1%. I'm talking about maybe 15 to 20 basis points or, so not even close to 1%. But, they do have that active component, and they might have like a systematic process where there's a screen, looking at the top cash flow yielding or free cash flow yielding companies in the Russell 1000, but there is maybe a subjective component saying, hey, this doesn't fit our mandate, and we might make a few changes based on that.
Yeah, right. Something you don't see, a shift to 401k plans for a minute. You don't see ETFs in 401k plans.
You don't.
And it's possible. It can exist. It can be built. I think there's some stretching you have to do there. But okay, so mutual funds, NAVs at the end of the day, very simple. Now, when you place a trade on an ETF, typically you should be placing that trade with a limit order because you're buying a stock. So if we were buying 50,000 shares of something, there could be a good chance on the other end there's not 50,000 shares that won't be purchased. Or if they do, it's at a higher price. So it starts climbing this price ladder, right? Well, imagine that in a 401k plan. Like, what's the best execution strategy? We have a fiduciary obligation to put forth the best execution strategy as a firm, but you may not have that inside a custodian in a 401k plan. And so basically the ETF could be purchased, and who's monitoring the price of that? And how do participants know? And how do you measure that? I mean, so you potentially have some bad actors that could be making more margin on those trades in a really big plans. I think what we typically see in really large plans is like what CITs, cumulative investment trusts, which have cost similar to ETFs, if not cheaper on the big plans. So I don't know that ETFs will show up inside 401k plans, and that's certainly a place that mutual funds still seem to serve a very good purpose,
Right.
Inside those plans. And going back to fees again, mutual funds will pay 12b1 fees, not inside a 401k plan. Hopefully, I had seen one recently that has 12b1 fees, but basically it's paying the advisor a commission, a recurring commission, to own that fund. Something else that you see, and I should have mentioned this earlier. If you go down to your bank, if you go down to an Edward Jones location, you go to buy a mutual fund, a lot of times there's a 4.25% commission on the front end. So you're going to pay 4.25% to buy the mutual fund, and then you're going to have to pay another 0.8 to 1.2% per year in 12b1 fees, right? And expenses. Where the ETF typically is purchased for free. So $100 in, $100 goes into being invested. And there's no commission being paid to anyone. If you did pay a commission, you're paying it directly to the broker to buy the ETF.
And I will say too, with a large brokerage like Schwab and Fidelity, there usually is a ticket charge for mutual funds, and I think typically it's like $20 on the buy and sell. So that's something to be aware of, and probably doesn't make the most sense too, like given your asset level. If you have a lot of assets, maybe it makes economic sense. But with ETFs, there are for the most part no explicit costs or trading fees at the large brokerage houses. And really, there's really no minimum investment, so you could just buy one share at the price of the ETF.
So shifting gears, we have a lot of podcasts on this. So I don't want to stay here too long, but you think about active. So mutual fund managers are typically active managers. Michaela's already mentioned that there's a 2% chance they beat the market over a 20-year period. In the short term, though, they have like this 35% success rate, which is why you see them advertised. They'll say, we beat the Lipper average over the last 5 years. Like 3 to 5 years is kind of their sweet spot, and when the active managers could potentially outperform. What you have to understand is we talk about this almost, I think, about every episode. We bring up the Spiva report, but people don't understand this, and it's so frustrating that they're not grasping it. But basically, you have the S&P 500 or the S&P tracks indexes and active managers, and says, hey, based on how you invest your money, here's an appropriate benchmark. Do you beat that over the long term? The answer is no. Large cap managers have a 2% chance over a 20-year period, about a 6% chance over 10 years, and then it increases from there in the shorter time period. Actually, 1 year is really bad. So when you're building out, when you're looking at your investment portfolio and you see nothing but mutual funds and active managers, high fees, inefficient investing, right? And you're making someone else very wealthy. Am I wrong, Andrew? You come from a world that still had some mutual funds, I believe, right?
I think
your old firm still have mutual funds in the portfolios.
So there are some cases where I think mutual funds do make sense, and again, they have to be high quality mutual funds from established firms. I'll just say like DFA. They've been around for a long time, based on academic research. But really, to me, mutual funds make the most sense in certain asset classes, and that's like fixed income or maybe even international equities. I'd say international equities, maybe not so much recently, but these markets are more fragmented. They're not as efficient as the U.S. market. So you do see better outperformance in those markets.
That's because they're active managers, not just buying based on market cap.
Right.
They're buying with some other rule that they're using.
Right. And there are more, again, there's a lot more dislocation in those markets, especially in the bond market, a lot more opportunities for active management to outperform. But yeah, I would say generally, from the large wirehouses that are pushing mutual funds, you don't really see exposure to those type of funds. It's more about the high commission, the high fee, that are not properly, that don't have a good asset allocation.
If they all say American funds and Lord Abbott, I would be concerned.
Right.
Those are the most expensive funds in the business.
Right.
Michaela, when you guys are doing planning, do you see any resistance of like, no, this is my mutual fund, or is it more focused on just like tax issues?
It's more focused on tax issues. Most of the time, most clients are really receptive to ETFs once they're explained. I think it's such a new, even though it's been around for 25, 30 plus years now, I think they started in the 1990s officially. And even though they are, on the market that long, it's not something that's the norm, I guess, for the industry still. It's getting to that point. But a lot of people have heard about mutual funds. It's historically what their parents invested in. It's what their grandparents invested in. They've been around since the 1920s. Like, that's the safe option, it seems like, for people, even if they're paying that premium. So it's kind of explaining the difference of, hey, the market is shifting and this actually is a better option for you in the long run. And that was a phenomenal option for them because it was the option they had provided, but now there's a better one. And it's just like the first draft isn't as good as the second draft. And I think this is almost the second draft of a mutual fund kind of.
Yeah, in the 60s and 70s, everybody was buying individual stocks. And then in the 80s, we had mutual funds. And then, the S&P 500 was created, SPY was created in 1991, I believe, for the purpose of being able to hold assets in the S&P 500 while they're trying to choose which stock to buy after a while, so they wouldn't miss out on market performance. And then that carried on into the early 2000s when we started adding more. The iShares products came out, started adding more diversified mutual funds. And then now I would argue that mutual funds versus ETFs is going to be an old conversation. And a couple of years from now, we're going to be talking about direct indexing. And and then we kind of go back full circle where we're going to have 116 securities inside of a portfolio individually selected by software that probably somewhat the same software that built the ETF, right? Except you're just kind of building your own ETF. And for us, this is going to be as important as some other firms that have agendas in their investing. But think about being able to buy the S&P 500 and you're going to replicate that. And then the whole new level of tax efficiency you have in direct indexing.
Right.
So that's probably the future. As I've said many times, we're an indexing firm. And ETFs are the vehicle for that right now, but it may not be that way in a few years. Yep. And you don't want to be first. No. You don't want to be first in that environment. We need others to go ahead that can fail and perfect the process. But that is something that we're certainly watching.
Yeah, and I actually do have experience with direct indexing, and there are a lot of different offerings out there. And I think right now, one limitation is just the minimum investment size, but those are starting to come down some. And then, as you mentioned, Casey, they call it tax alpha, but the additional, tax savings you can get from, these vehicles is phenomenal.
So if, when you think about, mutual funds, obviously inside an IRA, it's not that big a deal. Because you don't have any negative tax consequences. So it's really in brokerage accounts. So if you have a mutual fund inside an IRA, why would you care about switching it to an ETF?
All right, let me think about that. I would say, so within an IRA, one thing you do see with mutual funds, and again, not all mutual funds, but a lot of them, they do carry a little bit of an extra cash in their portfolio. And you might be paying a fee. You're paying a more expensive fee for the portfolio to hold that cash. And a lot of managers do this because they're just holding like a little cash buffer in case there is a flood on the fund. There's a lot of redemption requests coming in. So sometimes people refer to as a cash drag on that return. So again, not every, mutual fund is like this, but there are a lot of them that, where they might have a lower performance versus an ETF that tracks a similar benchmark.
I could see that. I go back to fees as well. Lower the overall cost of investing. I mean, if you can drop your investment cost by 0.5%, that's huge over a long time period.
Speaking of fees, Do y'all think that ETFs will ever like develop more fees than we're seeing now? Like, do you think bigger, like these big brokerage houses are actually going to start charging to trade ETFs at some point? Or are we going to start seeing there be more fees in ETFs overall?
I think the trend in that has been less and less fees. I mean, if someone can make a free ETF and figure out how to make a penny on it somehow, I think they would do it. Simply because, first of all, Schwab launched the whole free trade thing and totally changed the landscape of brokerage houses. TD Ameritrade doesn't exist anymore because of it. And then on the ETF side, there's a price war between State Street, BlackRock, and Vanguard on the S&P 500. The S&P 500, I remember when it was like 0.1%, and then that was cheap, and now it's like 0.03. And so if they just drop it by 1 basis point, then they get more market share. So it's about claiming who has the most in assets, I guess. Now on the flip side, it's kind of like, hey, this is our free offering. It's kind of like the gimmick when you walk into the store, buy one, get one free, right? But in the meantime, they have all this ESG propaganda that, don't even get me started. We could have a whole podcast on me ranting on ESG, but basically, what I'm saying is it's not. I'm not weighing in on the ESG political statement there. It's staying away from that. What I'm talking about is the S&P 500 has the highest ESG rating. Our portfolios have the highest ESG rating. However, BlackRock especially has come out with ESG funds that perform worse than the S&P 500, right? Have the same rating as the S&P 500 and charge you 5 times as much. They make $56 million more a year off of one large cap ESG fund. Yet our S&P 500, which has nothing to do with ESG, we probably own less than 0.5% of companies that maybe wouldn't show up in the ESG fund, right?
Right.
And yet we save $56 million in fees. So it's I call it, well, I didn't create this, but it's called greenwashing, where you say, oh, we're environmentally, social, and governance focused. And in the end, what you just did is what you just increased your cost by 5x, and you made Larry Fink at BlackRock like even more wealthy than he already is and more powerful than they are.
Yeah,
and so I just kind of roll my eyes and like this is no different than the low vol funds back in the day. They came out with low volatility funds because after the financial crisis, things were so volatile, and everyone moves in like herd mentality. So they all hurried to buy low vol. So many people bought low vol. It became more volatile than the S&P 500 itself, right? And so you have to be so careful as a asset manager that you're not following the marketing guidelines of whatever's out there, Right. It's like when we had the oil spill in the Gulf of Mexico. I was just waiting for because a lot of oil companies have high yield bonds. I was waiting for the high yield bond X oil. It's just marketing is very. They want to manage your money. They want to manage your money because they get a percentage of that. So you have to still steer clear of the gimmicky stuff and make sure you focus on the core.
Yeah, and again, we've already said this a few times, but going back to the ESG example, you really again have to just focus on what's in the portfolio. And these ESG wrapper funds, they claim that they have this high ESG score, but in the end, they're, mirroring what's in the S&P 500, just passive general ETF, and they're really not that different from a market cap weighting. So
no, it's no different than the other focused mutual funds that have exist. And there's also people out there that have the Patriot funds that buy everything that's pro-America, non-ESG companies, and those are underperforming too. They have periods where they've done well, but they're very short time periods. In the end, you want to leave politics out of your portfolio building, and you want to leave your emotions out of your portfolio building, because of course those kind of go hand in hand, but there's no place for that. And you just have to manage based on what has worked over the long term. I call them long-term healthy asset classes, right? So S&P 500, it's been pretty hard to beat. Very few have done it, right? Over a 20-year period. And it's probably going to continue to be that way. But the S&P 500 itself is, it's pretty woke, right? I mean, It's all the things that we get frustrated about because that's what's kind of the movement that's happening in these large companies. But we're not going to buy a fund that advertises that on the wrapper, and we had to pay 5x for it. That's crazy,
right?
All right. We have a YouTube channel. You guys ever watch the YouTube channel? A Wiser Retirement?
I've watched it a couple times.
Yeah. You've been on it.
I have been on it.
You're a feature.
I only watch mine. No, I'm kidding.
Over and over again?
Yeah.
That's where the 10 views came from. All right. So A Wiser Retirement, find that on YouTube. You can watch us live, or not live, but watch us recording our podcast. But we also have some other educational things we do on the YouTube channel that are separate from the podcast. We have one that we've linked here. Our financial advisors paid by mutual funds. That's a good one. Answers, well, I don't know. Tune in. Go find out. Podcast, episode 165, 5 Principles of Successful Investing. That's a good episode to learn about the basics of building portfolios. And then episode 96, back in the day, that's an old episode. We talked about the selection of small cap ETFs. Kind of like how we would go through and weed out funds to pick a fund. Let's see, what else? Thanks for listening to today's episode. If you're interested in learning more about Wiser Wealth Management or want to schedule a consultation to meet with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com, or you can click the link in the episode notes. All right, thanks guys, and thank you listeners. We'll see you next week.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This episode was produced and edited by Ken Hoadley.